Thank you everyone for joining the Providence market update for September. In the interest of time, we might commence today's session. So normally in sunny Melbourne, we'd all be enjoying the football finals at this point in time and probably be running around. But despite that, share markets and investment markets continue their choppy journey. And we thought it would be a good opportunity after our investment committee meeting last week to provide you with an update. So from the Providence team today, I have myself, James Smith, Grant Patterson, Mike Ogg, Harry Buckeridge and Carlo Queddeng. And during the course of this presentation, we'll be providing updates and switching between the team to share our thoughts and views. This session will be recorded, so we will be sending it around to our clients later in the day. And we will provide time at the end of the session for Q&A, and you'll find there is a chat facility within this webinar session where you can ask me directly questions directly, and we'll endeavour to get through as many as we can. So on behalf of Providence, welcome and thank you, and we'll make a start with Grant Patterson. So over to you, Grant.
Thanks, Jimmy. Just first, the disclaimer, this should be considered as general advice. It's not specific to your personal circumstances. And we'll just take that there as read. If we start off, I mean, I think it's fair to say it's been an incredibly intense few months, is the way that I would sort of describe what we've been going through. It's been quite tough because there's really been lack of real visibility in regards to what the outlook might be for the economy coming out of COVID, whenever that may be. And therefore, there's a lot of, if you like, speculation in markets and asset prices on the conviction of whether you believe that we can recover out of this quite easily despite the amount of debt, or whether we're likely to go into a long disinflationary environment. And I guess in two words, that's why we still maintain a defensive and diversified portfolio, given those uncertainties. So what we'd like to go through today is just overview of the macroeconomic environment as it stands. We'll run through each of the different asset classes and the opportunities and risks we see within those asset classes, and then we'll finish with our current stance. There's a few changes that have come out of our formal investment committee meeting just recently, and we'll run through that and then be open up for questions. So I think it's just important to remember in regards to the macroeconomic environment on the next slide, just the reminder of the quantum of fiscal stimulus that's been provided globally, which has been immense. I mean, I think that announcement on May the 12th by the Fed, where basically they gave a commitment to buy anything, including high yield ETFs, was a real game changer for asset prices. And we've had obviously huge fiscal response by governments around the globe. Government spending now for the G7's up around 42%, and there's been globally around about $9 trillion of support, which is hard to get our mind around, but that has certainly been quite extraordinary. Now, I think it's really important to notice on the next slide that this amount of stimulus, unlike normal recessions or even depressions, normally what happens is you get an income hit, people stop spending, and that's why the downturn comes in the economy. This time around, it's very different. Now, the result may be the same, but household balance sheets have actually held up very well because of the income support that governments have given in regards to wage subsidies. And we can see here on the chart, the green line, which is Australian household savings ratio, is up around 20%, which I've never seen in my career in the markets, and the US is up around 26. So that's giving a lot of support to the economy despite the unemployment rate. And we can see this on the next slide in regards to Australia, where retail sales have actually rebounded very strongly. And in a sense, that's not surprising since overseas travel is off the agenda, and yet income support keeps coming through. And the retail sales just recently up 3% for July, and I think up 12% from the previous corresponding period. So, you know, that's helped the economy. Now, we have had a very big fall in GDP, obviously, but in some sectors, particularly in the retail spending side of the equation, you know, income has held up reasonably well. Now, if I just go on to one of the issues that's gaining a lot of discussion in markets, and certainly we've been focused on watching, and on the next slide, you'll see that we obviously haven't had any inflation for some considerable time, and there's been some reasons why there's been a structural decline in inflation. But we heard recently from the Fed that they will tolerate inflation above their target. And when you have a look at some of the market indicators, we could see why we want to keep this on the watch list. So the M2 money supply figure in the States and the Eurozone has surged to unprecedented levels, which you can see on the left-hand chart. Inflation-linked bonds are starting to show some sign of pricing in higher inflation, only muted, but we've started to see that since about May or June. The green line is nominal bonds and the blue line is inflation-linked bonds. And we've also seen the gold price, which has had a very strong run from the beginning of this year. And that has traditionally been an area where investors may go to take some sort of inflation protection. However, after debating this quite substantially, we still believe that the deflationary forces or the disinflationary forces are still at large, and therefore we are not taking direct inflation protection in inflation-linked bonds, but we are having a look at some assets that would hold up reasonably well in the current environment. And if we did get a inflationary pickup, wouldn't be too badly hit. And for example, that would be in property. So if we go to the GDP chart, you know, we've had quite negative, as you've seen the GDP numbers here, with you know, US down to, you know, minus sort of 7% or so. So GDP declines around 5 to 10. I noticed that New Zealand's come out yesterday and their GDP has fallen to a minus 12 reading. One thing I think that's important to just keep a little eye on, which is a bit of a positive amongst all of this, is China has rebounded quite strongly. And Chinese growth, obviously China went into the COVID area very early and was first in. Their economy has shown some signs of growth. That's the green bar on this chart. So if that's any indication of what may be coming from the rest of the globe as the COVID numbers decline, that's certainly an area of some positivity. So what lies ahead, just what's keeping us awake at night, if you like. Obviously the US presidential election is coming up, which looks like it could be very close. We don't have a view one way or the other. The one thing that does worry us is, in a very divided country, as the US is at the moment, and the election coming up, the swearing in of the new president does not come in until January. So we would be just watching or be cautious in regards to unrest within the US until that is done. And it may, given that there's quite a lot of postal votes, a huge amount of postal votes coming in, it may take some time to get the actual result, and that would be unnerving for markets. Also, we have in amongst that some significant geopolitical tensions led arguably by China, but certainly there's tensions there with Japan and India and Taiwan, US and Australia with China, and that is something that is a little unnerving. And the other area that we're watching very closely is insolvencies. I mean, companies at the moment, company directors do not have to declare whether the company is solvent or insolvent. There has been a huge amount of debt being built up or deferral of interest over this period of time. A number of companies have stayed operational just so they can get the JobKeeper and pay their staff. And with the tapering of government support over the next 6 months or so, we believe that there is a risk of a substantial increase in corporate insolvencies. If we head now to just the asset classes, equity market performance has varied around the world. It's been quite an astonishing recovery from the lows, driven very much by the federal central bank's stimulus of the economies, and also the rise of the retail day trader that is having a meaningful impact in regards to stock market performance, and certainly has an impact within sectors. And we've obviously seen the huge rise in tech stocks, which have been the beneficiary of people staying at home, have been beneficiaries of the very low discount rate in regards to valuations, and has attracted the interest of the increasing retail investor. However, when you have a look at these charts, the blue line, which is the US excluding, sorry, the MSCI World excluding the US, it's underperformed the green line, which is the MSCI World Index. And all that's saying there is that the global indices have been led very much by US, and in the US very much by tech stocks. The Australian market continues to underperform, as it has for some time, and that's why we tend to have more equities in international equities than local equities. And the ASX has underperformed by around 20% from the MSCI Globe. Harry, I wouldn't mind if you could just go through in regards to the index and how you're seeing the Australian equity market.
Yeah, sure, Grant. I think that the biggest thing to note with the Australian market differing from the US is that we are vastly more overrepresented in financials, resources and industrials. We do also have a higher weighting to energy and property. Combined, they're probably the 5 worst sectors globally that have performed since the start of the year. That's been the biggest driver of the relative underperformance of the Australian market relative to the US. Our tech sector, although it does get a lot of press, and particularly companies like Afterpay, is still relatively small. The tech sector is only about sort of 3.5%, and in the US, it's getting close to 25.
So I think one of the things that is I make sure that the team pick me up on is when I talk about the index being expensive or cheap. The enormous dispersion that's around in markets now, in a sense, makes an index comparison somewhat irrelevant, because it's what is happening within the index which is important, and the huge dispersion around is distorting those indices. James, if you've got the example of that.
Yeah, I think this is probably the chart of the day in terms of trying to articulate what Grant is saying. If we look at the broad performance of the S&P 500 index in the US at the moment, we all know that it's rallied very, very aggressively since the sell-off in March. But if we actually look at the breakdown of what's been driving a lot of the performance within the US share markets, it's actually been what's often referred to as the awesome 8 companies, which since the start of this calendar year are collectively up 52%. So there are these 8 companies here on the right-hand side, which we're all probably familiar with. But when we take those companies away from the S&P 500 and see what the broader S&P 500 index has been doing, and perhaps as a reflection of the broader US economy, we can actually see that the S&P 500 in the index in the US this calendar year has actually been under pressure. So it just really reminds us about where the momentum and where the attention has been in terms of actual price performance.
So if we have a look then at where the value is in the market in regards to the broader market, the momentum has been pure all around growth, and that's been around the high PE technology stocks, which have outperformed the traditional value stocks quite substantially, which you can see in that chart with the blue line. In fact, it's surpassed the outperformance that growth had versus value back in the tech wreck in 2000. And there's a lot of similarities at the moment in regards to valuations and the percentage of market cap to what occurred back then. So when we have a look at the metrics, we have here growth stocks and value stocks. And growth stocks are currently trading on a price to book value of 6.8 versus a relatively attractive 1.6 for value. Price to earnings ratios in the growth area is 38.3 versus the value stocks of 17.4. Return on equity, much stronger for growth, and that's why it's got the premium as opposed to MSCI World. And in the important area of dividend yield, given that the lack of income elsewhere, the growth sector is providing a yield of under 1%, whereas value is up around 3.2. So we're not quite sure when the momentum may taper. I suspect it may occur post vaccine, but we'll wait and see. But we don't believe that you're getting paid for the risk at the moment in some of those growth stocks, and therefore, in order to protect and preserve capital and still get an adequate return for the risk you're taking, we've very much got a value bias in our fund manager selection. So our current stance in regards to equity markets, we're maintaining an underweight to Australian large cap equities with a preference for international equities. We believe there's better value in Japan and Europe than there is in the US, which we think is quite expensive. And once again, this is at an index level, so we need to be a little bit careful on that. And our skew, as mentioned before, is very much towards value rather than growth. We might head off to the next asset, which is property, which we are seeing quite good opportunities in the property sector after quite an aggressive sell-off. And I'll hand over to Harry to run through a couple of statistics from the listed side.
Yeah, sure. Jimmy, it might be good to go to the next slide just to have it as an illustration. But this sort of really tells the story of where our attraction to the ASX listed REITs is. So the key figure for us is the implied value decline and the implied cap rate. When we're looking at some of these centres, and particularly at the peak, which is when we purchased a holding in Vicinity Centres for clients, these discounts got towards 40 to 50%. And it was at that level that we thought the market was potentially trying to capitalise a basic permanent dislocation in consumer trends. Our experience in actually physically going to the centres between now and then was that consumer traffic was actually quite robust, ex-CBD assets, that is, and ex-Melbourne as well. So our attraction here is that we think the implied cap rates of 7% and the implied discounts, which have narrowed a little bit, but are still quite attractive, basically reflect value for us, and it's that defensive value that we think we can use.
Within the direct property, so we are increasing our weightings to REITs predominantly in the retail sector. We're wary of the commercial side, and I note recently the amount of sublease space that's come up here in Sydney is incredible. It's the sublease space is up 90%, 115,000, I think it is. 157,000 square metres of sublease space has come onto the market. To give you an idea, back in 1992, that was about 110 at the worst of it. So there is a lot of space looking for a home in the commercial side. So we're wary of that. In the direct property, we're still attracted to some niche subsectors in the unlisted property and the infrastructure market. Regional Australia, we believe, will be an ongoing beneficiary of the change in workplace and in regards to people's desire to not necessarily work in a city. So whether it be through domestic tourism, relocation, land affordability, we believe regional Australia will be one of the beneficiaries. And that's why we're looking at seeding a regional hospitality fund where we see good opportunities in that area where certain assets are probably poorly run at an individual level. We'd like to put some corporate structure around that, professional management, get a solid yield, and also the regional economies tend to dance to a different tune than in the cities. We're also having a look at disability housing, underwritten by the NDIS rental assistance scheme, which is providing some opportunities there to have a social impact, positive social impact, but also get a adequate government funded, if you like, return, which will boost income as well. Global core infrastructure, we think, is going to be a beneficiary of the ongoing government support around the globes for jobs. And the other area that we quite like still is property loans. These are first mortgage, fully secured loans to developers on completed product, residual product, not geared more than 65%. So you've got a big buffer of equity if the borrower fails to make their mortgage requirements. You have first mortgage, fully secured, no construction risk, and you're receiving around about 7.5 to 8.5% income. Normally they run for 12 to 18 months, and we'd normally have a basket of these across different sectors, different managers or different developers or loans, and maturing at different times. So we keep rolling that through. It's only probably around for a little while the banks aren't in that space, but we're taking advantage of that in this low income environment. In regards to credit, in the fixed income, we're still not attracted to the credit sector. We're not convinced that you're getting paid for the risk. Global leverage is very, very high, and we still believe that there's some way to move in regards to insolvencies. On the left-hand side, you've got the global debt levels, which we know is quite high, but as a percentage of GDP, which is that red line, we're talking about a percentage of GDP in this global debt in the order of 300 odd %. It's very high. And we're starting to see some of the defaults in bonds on the right-hand side. The percentage of gross issuance that's defaulting has now sort of picked up, which is not surprising given what's happening in the US oil shale side, and also the fall in the GDP economies. And when we have a look at what you're getting paid to take that risk, on the next slide, it's the credit spreads in high yield. And although they did spike obviously quite high in the February, March time, they've come back to levels that we still think are quite low given the uncertainties that's in the market. So we're a little bit wary that credit spreads are not paying you for the risks that you take. And you can see back in 07, 08 in the GFC, you were getting 600 odd basis points. So halfway down after the big spike, the spreads came down. They're still trading around 600 basis points over. We're now only about 150 basis points over, and I would argue that there's still not much certainty exactly how this is going to pan out. So we'd be cautious on high yield credit. In government bonds, you're not getting much of a yield at all, and we get questioned quite significantly, well, why do you have them in the portfolio? The major reason we have them in the portfolio is they're as a diversifier, and by having the protection in the portfolio from the bonds, that enables us to increase our weighting to risk assets that we quite like. On this chart, the red is the peak to trough in market corrections. So the far left one is 07, 08, where we had a 40 odd % decline, peak to trough in equity markets. And you can see that the bond market, the blue line, dark blue line, was up about 20%, which gave you some protection to that downturn in your risk assets. And that's the reason why we have the bonds in the portfolio at the moment, is that we want to make sure our risk assets have some protection in case of another downturn. Obviously, the thing to worry about bonds is if there's any sign of inflation you have duration risk, and that's why we're watching that very closely. But at this stage, we believe that Australian government bonds on an international basis look quite attractive. And only recently we saw demand of $60-odd billion for a $24 billion offering by the government. So we think they're very well supported at current levels. I'll go on to the alternative space. Carlo, if you just could go through what our exposure is there.
Sure, yeah. Thanks, Grant. So our alternative strategies are there to provide absolute returns and diversification strategies, not correlated to equity market beta and fixed interest beta. Gold, which is as a store of value, has performed very well this year when central banks have been devaluing their currencies. It's up around 16% this year. We also have Ardea, which is a relative value fixed income strategy, which provides returns independent on the level of interest rates or direction of interest rates. And that's also performed 6.5% this year. We're looking at market neutral strategies at the moment and other non-correlated diversified strategies.
So that's the asset classes besides cash, and that brings us to what we were having quite a lot of discussion about in the investment committee meeting. If we go to the next slide, the opportunity cost of owning cash now is becoming too great and a drag on the portfolio. But we still want to remain defensive and make sure we've got the protection in the portfolio. So what we're doing is adding other liquid assets that allow us to add risk while maintaining portfolio stability. And what does that mean? We are reducing our cash and buying bonds. Slight pickup in yield there. We're having a look at increasing our property exposure to boost our income. And we think by gradually deploying some of the cash to some assets that have been left behind or aren't sort of at the top of the pops, if you like, but also maintaining a decent level of protection through gold, through our alternative assets, and through our bonds, we believe that we can increase the expected income and return from portfolios without substantially increasing the risk. So our current asset allocation looks somewhat like this, and this is just the model. Every portfolio is different, but it gives a guide of what we're favouring and what we're cautious on. So we're currently at 15% Australian equities, and we'll maintain that. That's pretty much at the lowest level we can get to in regards to making sure we've got a diversified portfolio. International equities, we're maintaining a 25% weighting. As I mentioned, we're more focused on value than growth. One of the important decisions that we made a month or two ago is that we hedged back into Australian dollars half of our international equities, which added about 17.5% of performance, because the Aussie dollar at that stage was below 60 and is now up around 75. So it's helped the portfolios. We still believe half and half is about right in case we do get another event in markets. Property and infrastructure, we're looking to increase that exposure predominantly through infrastructure weightings. Bonds, we've increased that up to 15%, or going to from 10. Credit, we're reducing. As I mentioned, we're quite cautious about credit, and the only real exposure that we've got there is right up at the top of the capital structure in investment grade or asset-backed securities. Cash, we're reducing from 20 down to 15, and we may actually look to do that further if alternatives provide themselves. Our alts are around 5%, and gold we're maintaining in the portfolios as some protection. So I think before I conclude, I guess, James, if there's any questions or that you wish to fire at us.
Thanks, Grant. There's no questions at this stage, but just encourage our participants to use the chat facility where you can ask questions directly to me, and then I can pass those on to Grant or other members of the team to answer on your behalf. But I think I'll start with a question that I think is really interesting in this environment and goes back to the point about the uncertainty during the course of the first 6 months, and perhaps back in March and April where there was genuinely a lack of visibility. Is just, if we look at listed equity markets, be it Australia or in the US, and I'm sure it's the same for other developed markets, how little guidance management are prepared to give at this point in time. And just wanted to see, Grant, if you wanted to make a comment of that.
Well, yeah, as I mentioned, there is little visibility, and you know, as stewards of our clients' hard-earned capital, we want to be very careful not to jump at shadows because of momentum in markets without a bit more certainty. I mean, that's why we're happy to deploy money in, you know, the property loan side. You know, it's very visible, you know, not overly geared. You can see the building, you get an idea that, you know, people are still going to shop. It might be at different levels or different volume levels, but, you know, there is some visibility there. So the stance that we're taking without that visibility and as stewards of our clients' capital is to remain nimble, diversified, defensive, and be very careful not to, you know, jump at the latest momentum that might be on the chat lines.
Thanks, Grant. I've got a question here with regards to the banks, just asking, will the banks come under a lot of pressure with the rise of bankruptcies to come?
I'd like to defer to Harry with that on the direct equity side.
Yeah, I think that's absolutely a fair question. I think they will undoubtedly have some pressure. I think that the starting point is the provisions that they've already made, which are accounting for a sort of fairly dramatic weakness in the local economy. I think even though the question was about insolvencies, you do sort of split it between residential mortgages and stress at the household level and at the SME level. Across the banks, they are certainly struggling more to get SMEs from 3 sectors really back into paying their loans at a normal level. Understandably, it's basically from commercial property, tourism and hospitality. They're the 3 that are really struggling. Of the banks, NAB probably has the most SME exposure to Victoria, and that's almost stating the obvious, likely to be the biggest pocket of stress. At this stage, I think it's too early to say just how dramatic that level will be. The banks are obviously very concerned. They are actively contacting their customer base. And I think the biggest thing is APRA is publishing pretty regular data on deferred mortgages and deferred SME loans. So we do have reasonable visibility on how the loan books are evolving, which is very different to other periods of loan stress. But it is a big concern for us. That's the big thing that's stopping us from going or looking at going overweight the banks at this stage.
Thanks for that, Harry. Another question here is, what is your time frame for inflationary pressures?
It's a great question, and the feedback that we're getting from our from Mark Waite on our investment committee, who has great experience globally in regards to bond markets. His view is it's still some time off, so he would not be concerned about inflationary pressures within the next 1 to 2 years. BCA, Bank Credit Analysis, which is our independent global asset consultant and research house that we utilise on behalf of our clients, they have raised the spectre of inflation, but in their view, it's not until 2023 or 24 where we might need to sort of worry. Now, I think the thing that's really important, it's not actually the inflation rate that's a problem at the start. It's when inflation expectations start to build in the potential for inflation. So that's why we're watching, you know, the M2 figures the inflation-linked bonds, the golds, all all those different areas to see when the market may start focusing on that. But when you have a look at the M2 and the money supply, which looks very inflationary, if you have a look through and have a look at the velocity of money, the velocity of money is very, very low. Banks aren't really wanting to lend, and corporates and companies, have already borrowed as much as they can pretty much borrow, and tend to be borrowing from the private sector anyway. So it'll be a discussion every quarter in our investment committee, but at this stage we're not fearful that it's anything that we need to worry about over the next 12 to 18 months as a minimum.
Thanks, Grant. Next question I might put to Mike Ogg, if I may. If all the money is going into growth, why are we investing in value?
Yeah, Jimmy, that's a good question. Can we go back to that slide of growth and value?
Just bear with me. Oops. Hopefully everyone can see that.
Yeah, hopefully everyone can see that. Yeah, I really like this slide because it sort of shows that growth, well, value actually, which is when the graph's going down, is outperforming, and when the graph's going up, growth is outperforming. And so through time, value generally has outperformed. And every now and again, you get a spike of growth coming up, especially in the dot-com boom. Growth spiked up before value then won through again. So the way we approach this is we don't know which one's going to outperform at any given time because it is random. So we blend our fund managers. So in our international fund managers, for instance, we have 4 fund managers, and they've all got different styles. There's a growth style, there's a value style, and there's styles in between. So because we don't know which style is going to perform at what time, we just blend the managers to make sure that blend through the cycle outperforms. And over the last 20 years, the blend of 4 managers has actually outperformed through the cycle. Right now, as you can see, growth is outperforming substantially. So we are taking more of a value bent right now than we would normally do. But that's just because the dispersion between growth and value is at such extremes at the moment. We're taking a tweak in the portfolio.
I mean, you're right, Mike. The combination of, like Magellan, for example, have had very good exposure to some of the growth names in the US in particular. So the combination works quite well. The only other comment I'd make is that it gets quite uncomfortable when you're watching, the momentum traders in the market and you're not in the game. But we aren't, as a house, a trader or a momentum driven group. We tend to try and look for value and valuations. We're respectful of what's going on, and that's why every time we had a look at this, we looked through all of our fund managers, and we felt that there was some exposure to growth through the likes of Magellan. But what we're seeing now is a very dangerous, in my view, period of time in a small number of stocks or in a sector, similar to what I think we saw back in 2000.
Yeah, Grant, and I think the paper on platinum actually addresses this somewhat. We've still got platinum in the portfolio. They are a value manager. Value has been underperforming, and the easy thing would be to sell platinum and put into the growth managers. But I think potentially doing that at the wrong time. So we're holding the course and making sure that we do have value in the portfolio.
And I guess a point to add to that, Grant, and you might want to add to this comment, is that the expectation is as certainly as the vaccine ultimately emerges, and that's something that we've had a lot of internal debate about what the other side looks like when a vaccine arrives. But the expectation that the real world economy, and indeed many aspects away from those bubble-like stocks in the US, are likely to see favour, which in our mind really reinforces why there is a place for value within a portfolio.
Yeah, I mean, I think it's a good point. I mean, when you're investing, you've got to have a look forward rather than backwards. I mean, the real question is, what do we think the world looks like when a vaccine is available? And, you know, that's not stating that everyone's going to, you know, take the vaccine, even if it's there. But, you know, what does the world look like? And the world, and that's where we're starting to try and position the portfolio. To us, the world looks difficult. I mean, you won't have the support that we've had from governments to the extent that we've had. You will have some pressure in regards to corporate balance sheets because of the debt levels. You know, I think we need to be a little bit careful about what we wish for, in the sense, because the market generally is pricing in a very strong rebound in corporate earnings. And so, you know, we might have a vaccine, but we mightn't have any growth, you know, longer growth, not the initial rebound, but longer term. So, yeah, we're very much keeping and trying to keep an open mind on that.
Thanks, Grant. A question here is asking the Providence portfolio, and as we said, every client portfolio is different, but what level of we'll use the model as an example, what level of the model portfolio has exposure to the Awesome 8 stocks that we talked about? So just probably a broad answer could be that through the 4 international fund managers that we're using, there is a fairly broad exposure to the technology sector. But in terms of a specific quantum, I think we could probably take that question on notice.
Yeah, we are.
I was going to say, Jimmy, it'd be quite low at this stage, because even though Platinum did have some exposure, they've reduced it a lot. Magellan would still have some exposure, but not a huge amount. And Walter Scott wouldn't have much exposure at all. And I know that VGI has got Amazon, and I think that's it in terms of the Awesome 8. So it's not a very large exposure in clients' portfolio anymore. Actually,
just to add to that, Mike, and it might be a good thing to comment about you know, our views on active management versus value management or exchange traded funds, and why, particularly in environments now where you do have some very much extreme valuations, the importance of an active manager. Did you want to touch on that?
Yeah, sure. I mean, look, we've always believed in active management. So we believe that over the cycle, active management adds value, and that's been certainly the case in our 20 years. At certain times of the market, the index does take over, and that is money which is price insensitive, and that will flood into the Awesome 8, and we've seen that, and it perpetuates until it doesn't, because the money go in without a view in the price or the valuation, because it has to go into the index. So you get the Awesome 8 growing like they have. An active manager will at some point say the valuation's too high and would reduce that position and buy cheap stocks. And you can't time it, but at some point, the market will look back at value and make value the important anchor for share prices. That anchor isn't there yet, but when it does, it can be quite extreme. So active management right now is very important, because valuations are extremes, and we want to make sure that the capitals and managers that have a value anchor when they're pricing stocks.
And just with that in mind, because there's a little bit of questions around the Awesome 8, which of those stocks that have had the very much bubble-like behaviour in the US, just perhaps if Grant or Mike, you want to just touch on the importance of diversification. And while it is nice when you have stocks that are rallying aggressively within a portfolio, but the importance of bubble-like environments and what can happen when the bubble bursts.
John, this is your behavioural finance. So.
You know, it might be different this time, but the result will be the same. I mean, you know, Amazon was down 90% in October 2000. Now, I don't know what, you know, Tesla's worth or Apple's worth or whatever. I can tell you that it's not cheap, but I don't know what it's worth. And I find it very difficult for people that are buying stocks at these levels on PEs of 20s, 30s, 40s, and doesn't even matter because there isn't any earnings, how you know what the world's going to look like in 10 years' time, let alone what it's going to look like in the next 12 months or so. So, you know, behaviour, one thing that hasn't changed, if you go to the 20-year slide at the end there, James, one thing that hasn't changed is behavioural finance. And as I say, it might be different this time, but the result, I'm sure, will be the same. So, you know, what we need to make sure that we are is that we're humble and respectful of markets, that we're nimble and take advantage of when things, you know, present themselves, and remain diversified, and you know, ensure that we've got a portfolio and some managers that are covering some of the areas of the markets that, you know, that we're not. So it's probably a bit of a no answer, but we do believe that, you know, the protection and preservation of capital is the #1 concern, and some of the behaviour, I think, in the market at the moment on a behavioural finance side, whether it be Davey the day trader, the amount of retail households who are now punting the markets on a day-to-day basis, I think we need to be careful.
Okay, thank you very much, Grant. And in interest of time, we might wrap it up there. So if anyone had any questions that we didn't answer, please feel free to contact any one of the team to address your questions directly. And on behalf of Providence, thanks, Grant. Thanks to the team for joining us.
Thanks, reiterate James's comments. Thanks very much for joining us, and all keep safe.
Thanks, Grant. Thanks, everyone, for joining us.